cash secured put is easily one of the best option strategy that I think everyone should learn. Not only does it give you some nice passive income, it also pays you to buy the stock that you wanted to buy anyway. In this video, I'll be covering everything you need to know about selling cash secured puts, such as what even is a cash secured put? What's the best way to sell a cash secured put? What will happen after you have sold it? Finally, I will also show you a step-by-step guide on how to sell cash secured puts on interactive brokers. Also, do join my Telegram chat group to discuss stocks, options, and personal finance if you have not done so. First up, what is a cash secured put? In simple terms, a cash secured put is where you are promising that you'll be buying shares at a fixed price by a certain date, and that's it. That's what a cash secured put is. Now, if you are new to options, you'll be like,
what did you say?
But don't worry, because once I show you how it works, you will soon understand this. So let's do a quick recap on what a put is. When someone buys a put, he or she is betting that the stock will drop in price. But who does he buy it from? The answer is a put seller, like you. When you sell a put, you are creating a new put out of thin air and sell it to the option buyer. Then when the buyer buys the put from you, he will pay you some money for it. Now let's take a look at an example to understand what I just said. Let's say I have a stock that is at $100 now. I can sell a put with a strike price of $90 with an expiration date that's 1 month away. By doing so, I'll get paid some premium by the options buyer. Okay, some people call it premium, others call it money. It's the same thing, yeah? Let's say the premium is $3, but because each option contract represents 100 shares, I will get to collect a total of $300. The moment I sell the put, the $300 will immediately come into my account. The money is mine now, and I can choose to do whatever I want with the money. I can spend it or I can reinvest it, whatever. Now, one of the two things will happen. First, the stock price can stay above the strike price. This is called out of the money. That's because if the stock is at $110, you would rather sell the stock at $110 and not exercise the put option to sell the stock at $90, right? That's why all put options below the stock price are called out of the money, because it wouldn't make sense to sell a stock at anything below the current stock price, right? If this continues all the way to expiration date, the put option will expire worthless. And that's the end of the story. You get to keep the $300 and you don't have to buy the stock. And everyone lives happily ever after. Well, everyone except for the options buyer because he lost money. So that's the first scenario. Stock stays above the option strike price, option expire worthless, and you get to keep the premium. Now, let's talk about the second scenario. This time, the stock drops below the strike price to $80. The option has now gone in the money. Why? It's called in the money because it's now better to sell the stock at the strike price that is higher instead of the current stock price. When this happens, the options buyer will want to exercise the option to sell 100 shares to you at the $90 strike price. The important thing to remember is you will still get to keep the premium no matter what. But because you are the option seller, you will now have to buy 100 shares from him at the strike price. The official term for this is you are getting assigned 100 shares at the strike price. And here's the biggest risk of selling cash secured puts. Because the more the stock falls, the bigger your unrealized loss. For example, if the stock falls all the way to $50, all of a sudden you are now sitting at an unrealized loss of $4,000. However, if you just follow this one important rule of selling cash secured puts, you'll be fine. And that is only sell cash secured puts on stocks that you are happy to own. Because if it's a stock that you want to own, and if it's a price that you are willing to buy at, you'll be okay even if the stock falls further. Because you know that based on your research, the stock will eventually go back up. So it kind of negates the risk of selling cash secured puts. That's why you don't sell puts on rubbish stocks. Even though the premium may be high, but when you get assigned, trust me, you will eventually get assigned, you will owe liao. Even the high premiums won't be able to save you. So only sell cash secured puts on the stocks that you want to own. But here's another advantage of selling cash secured puts. Going back to the previous example, while I got assigned shares at $90, my average buying price is actually not $90. That's because I was able to collect a $3 premium. So in reality, my average price has now been lowered to $87. And that's why selling cash secured puts to buy shares is so good, because you will get paid no matter what. And if it's the shares that you want to own, that's even better. You get to reduce your average buying price while also buying the stock that you want at the price that you are happy with. Okay, before we move on, I also want to explain something which gets many people confused. when you sell an option and if the stock goes against you, you might see the option price go up. Take for example, here I have an Apple put that has a strike price of $195 with an average price of $1.60. But since Apple, the current value of this option shot up to $3.52, which means my unrealized loss is now $208. But remember, I've already collected the premium beforehand. So if I decide to do nothing, this unrealized profit or loss doesn't affect me. This unrealized loss will only affect me if I want to close the option early. So in this case, I would have to pay $208 to close this contract. Now, let's talk about another scenario where if the option starts going in the money and you suddenly change your mind, you'll be like,
actually, I didn't want to buy the stock at this price. Then how?
You can then do something called rolling an option. Rolling an option is just buying back the put option, in this case at a loss, then selling another new put option to cover your loss. To do this, the new option has to be further out in the future and the strike has to be either at the current strike price or at the lower strike price. Going back to the previous example, we initially sold a put at $90 strike price and collected a $300 premium. But now, because the stock dropped to $88, the option price has gone up to $500. By closing this option, we will lose $200. So what we can do is look for a new option that's further out in future, like another month away, then choose a lower strike price, like $85. This time, the new option is worth $400. So if we do the math, we initially collected $300 premium on the first option, paid back $500 to close the option, then collected another $400 on the second option. Overall, we have earned $200 while at the same time reducing our strike price and avoiding assignment. However, just take note that this may not work sometimes, especially if the option has gone too deep in the money. So there's rolling an option where you close the current option and open another new option at a further expiration date and lower strike price to avoid assignment. Finally, here's the last scenario. Remember how when I said the option has stayed out of the money, it will expire worthless? In most cases, you don't want to hold it all the way to expiration. Guess why? Let's say you sold an option that expires 1 month out, but by the end of the second week, the option has dropped to 20% of its value. Rather than waiting 2 more weeks to earn the remaining 20%, it is much more efficient to close the option and sell a new one to earn another round of premium. The second reason is that as long as the contract is still open, you will still have an obligation to buy the stock if ever the option goes back in the money. I'm sure you have seen stocks that suddenly U-turns and drops quickly, either because of some bad news or some bad earnings. So by closing the option early, you are locking in your profits and will no longer have the obligation to buy the stock. The last reason is that options that are out of the money tend to decay slower. You might have seen graphs where the closer the option gets to expiry, the faster the decay. But that's only if the option is at the money. In reality, the decay of out of the money options actually tend to slow down when the option gets closer to expiry. So always try to close the options at around 50% profit and don't hold it all the way to expiration. I will now show you how to sell a cash secured put in Interactive Brokers, but the steps will be similar on other platforms, yeah? Let's try this on Apple. To do that, I can click on the options button to open up the options chain. The first thing that I want to do is choose an option that is further out in time, so there's more extrinsic value. Let's go for January 26, 2024, which is about 31 days from now. The next thing we want is to choose a strike price that you are comfortable with. But if you are not sure which is a good strike price, what you can do is open up the Apple chart in TradingView, open up indicators, then search for support and resistance. Then choose the support and resistance levels with breaks, lux, algo. Change the time period to week, and here you will see some support and resistance for the stock. There's a resistance line at $176, so I think it could be a good entry point for Apple. Let's head back to IBKR. We'll go for the $175 strike price. I can then click on the bid price to create a sell order. Fun fact, this option has a probability of profit at 98%, meaning this option has a 98% chance of staying out of the money. This number corresponds to the delta. So the lower the delta, the higher the probability of profit. Anyway, click order to start doing up your order. For quantity, I will just leave it as it is since I want to sell one options contract. For order type, some people would recommend using limit order. Then set the limit price to the mid price between bid and ask price. This will get you the best possible price. But personally, I won't really bother too much since the difference between bid and ask is quite small. So I'll just go for market order instead. One useful feature is that RBKR also lets you attach other order types on top of this order. So if you want to take profit early, you can enable profit taker. Then set an order to close your position at the 50% profit. Once you're ready, you can click preview. Check your order to make sure you have selected the right expiry date, strike price, and most importantly, you are selling an option instead of buying. If everything is correct, just click transmit order. Then to check your order, you can head over to trade, orders and trades. Then you will see your order here. In my case, the order is still at 37 cents. So I've collected $37 in premiums. And I've also paid $1.04 in commissions. Next, let's check out how to close an option. Here, I've sold one Google put at the $139.50 strike price. The average price is at $2.56. But now, the option price has dropped to $2.24. So that's about 12% profit. But let's just imagine we are at the 50% profit. To close this option, you can click on the three dots on the right, then click close. Then everything is the same here. You can enter in how many contracts you want to close, set the limit price and order type, click preview, then submit your order, and you are done. Finally, here's how to roll an option, aka close the current option, then sell another new option. There's no way to roll an option in the web platform. So I will just show you how to do it in the mobile app. To roll an option, tap on More at the bottom right, option exercise and roll over. Let's try rolling the SPY put by tapping on it, then tap roll position. At the bottom, you will see that it's already going to buy back the option, what's the break-even price, and how much you are going to buy it back for. So what you need to do now is look for new option to sell. Let's go for new option that's about 30 days away. I'll just go for the $470 strike price. Then tap on roll option. After that, everything is the same. Just choose your order type, enter your limit price, then select to buy, and you are done. So that was a quick tutorial on how to sell cash secured puts. This gives you a really good way to buy stocks that you want at the price that you want while getting paid for it. Also, I have a free options spreadsheet if you need a way of keeping record of all your options trades. Anyway, that's all for this video. Hopefully, you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.